Good morning, everybody. Welcome to the game plan. My name is Gareth Soloway here at verifiedinvesting.com, and we're going to delve into the charts. I've got a lot to go over today. The markets themselves are somewhat on the quieter side as we await the Federal Reserve decision at 2 p.m. and then the 2:30 press conference from Jerome Powell. But there are some key things that could give us a little insight into the action in the markets on that result or on that news, as well as going forward. So first, let's just take a look at what the markets are doing this morning. So what we see is yesterday we had that nice pullback. Basically, a majority of the downside was seen in the first 30 minutes of the day. This is the 10-minute chart. This is yesterday's price action. So you can see markets opened right here. We basically went down 3 10-minute candles in a row, and then look at the rest of the day, just sideways chop into the end of the day. So essentially what the markets were doing is they were erasing the prior day's gains and then going into a holding pattern going into today's Federal Reserve announcement. Now, this was your overnight action here going into this morning, and then this is pre-market here just before the markets open. We have trended slightly higher, just slightly on the markets here in the early action, but certainly nothing to write home about, nothing that can't be wiped out or accelerated to the upside on comments by Jerome Powell. Now, talking about Jerome Powell today. So number one, there's going to be no change in interest rate policy. That's not up for grabs. That's not a question mark. It is what it is, right? The markets are pricing in basically 2 cuts the remainder of the entire year. That won't start until June. June's really where, as of now, the markets are expecting. Now, today when Jerome Powell comes out, what are we looking for? We're looking for commentary on his dovishness or hawkishness, his commentary on the U.S. economy, on their interest rate potential for cuts. Are they going to be a little bit more aggressive trying to cut rates, or are tariffs and the uncertainty of the inflation picture going to hold them back? And basically that's where you're going to get your reaction today. In other words, the first half of the day is generally the most active, but on Fed days it probably will be more quiet, with most of the action later in the day starting at 2 p.m. today. So just keep that in mind. Now, looking at the daily chart in terms of the technicals, what do we have here? Well, we still have our parallel channel, and remember, I still have this upward sloping wedge, which is what we broke down from. I want to keep that on our chart to remind us that the markets were in an uptrend, and now they've broken that uptrend to the downside. Now, we did find support right here, and you get a parallel from this high to this high, which then stretches down to this low and gave us this exact low right here. But again, if you look at the bounce so far, I would classify this as being a weak bounce. Why? Well, we got one day up on Friday, a second day up on Monday, so that was a good start. But then Tuesday yesterday wiped out the entire move from Monday and then some. All right, again, if we had had a down day yesterday, that wouldn't be a problem. But again, if it was a down day yesterday that just took away half of the gains from Monday, that would have been considered a better or stronger sell-off or kind of stronger market, meaning in terms of just erasing a little bit of that down move versus erasing the entire Monday move and then part of Friday. Now listen, it can all change today. The markets are going to read into what Jerome Powell says and are going to make a major move most likely. The question again is it to the upside or the downside? Technically speaking, I'm slightly bullish going into this. Doesn't mean I'm going to be right, but again, I'm slightly bullish. I think people are very nervous about Jerome Powell's comments, which means they're prepping for bad news, maybe a more hawkish kind of wait and see attitude. And in general, I think he could be a little bit more dovish. That's just my personal insights. And again, the mere fact that in general, when you see a decline from all-time highs like this, it's very rare that we go into an all-out bear market with just straight downside with almost no bounces. Generally, enticing buyers that have been sitting on the sidelines, they can be lured back in to buy the dip, and oftentimes you'll get a little bit more of upside before the expected next downside move on the markets. Now, next, what I want to do as we walk back to the computer here is I want to take a look at the overall chart. So this is the S&P monthly chart going back to really 2009 right down here. This was your 2009 lows. And the reason why I'm showing this is, number one, it shows us how we were grinding up in from 2009 to about 2020, which was COVID. And then you had the drop on COVID, and then the steroids really kicked in, and we went vertical, the bear market of 2022, and then vertical again. And it just shows you that, again, if you look at the bigger picture on the S&P, this was your dot-com run-up. This was your financial crisis run-up before the financial crisis. And then look at the vertical move. And this is what, to me, keeps me up at night. When I see these vertical type moves, which are just so high with, yeah, we had a pullback here, but again, the vertical nature of it really makes me think that we're due for another major 2008, 2009, or even 1930s type move in the markets because of this vertical nature. Now, one of the things I do is when I'm looking back to history, right? If you go back to the 50s, you can't even see anything back here, right? The 50s, 60s, 70s, it looks like nothing's there. To change that, what I do is I go to the logarithmic chart. Now, the logarithmic chart puts things in percentage perspective versus price perspective. So it gives us a little bit of a clearer picture on the markets. And the first thing I see here is, number one, when we do logarithmic and we go back to 1929, just before the 29 crash into the Great Depression, you have a trend line here that basically goes up. And this is, again, I showed you guys the NASDAQ one that went back to the 2020 period, but look at this. This is kind of jarring to see a trend line that starts at the roaring 20s high just before the Great Depression on the logarithmic chart, and it connects through the highs of the dot-com, and lo and behold, what did we just tag at the highs before this beginning rollover? We just tagged that same trend line. So again, none of this trend line alone does not make or break any towards sort of guidance. It just makes me aware as an investor that we are at levels that previously have seen major market bear markets or depressions, great recessions, whatever you want to call it. Another thing to keep in mind is if we take the low from 1932 on the S&P on a logarithmic chart, and we stretch it up, we can see that there is a trend line here. There is a trend line, and it's basically parallel. So again, think about that, is we've basically been in a parallel on the logarithmic chart since 1929, almost 100 years ago, and it connects through the low here in 32, the low in 42, kissed it here in 49, in 1975, in 1982, and then we again see that the markets really have gotten their energy back. Now, what happened in 79 to 80? The Federal Reserve got their second mandate, which was to pay attention to unemployment. Remember, prior to, I think, 79 is when they got their second mandate, it was all they had to worry about was price stability, right? Basically inflation. But here is when they started to have to say, okay, well, we have to now worry about essentially unemployment, meaning if unemployment gets too high, what do we have to do? We have to stimulate to bring people back to work. Well, look at what the markets have done. So the markets went up from the 80s essentially to the dot-com bubble. Then we had our, obviously, dot-com collapse, upwards to the financial crisis highs, or just prior, there's your financial crisis. And then what do we know that happened right in 2009? Quantitative easing. And what does the market do? It goes parabolic vertically right into this trend line. All right. Now, again, if I'm a trader, which I am, and somewhat of a prognosticator looking at where this market could go, what are the things that I start to think about? Well, we know that when you hit the high of this line, you tend to retrace significantly back down. Does that mean we could be headed down towards the low end of this almost parallel? It doesn't look quite parallel, but it's pretty darn close, which would honestly, if you look at this takes us back to like sub 2000 on the S&P. Again, if that happens, this economy is in a lot of trouble. And again, these are things I want to just be clear on, right? So if we think about this, it doesn't mean this is going to happen. But my job is to always be prepared and think 10 steps ahead. Right? I usually trade on one step ahead because that's going to be your near-term move on a swing trade basis. But I'm always looking for where could we be going? And you start looking at the breadcrumbs, the U.S. deficit. You look at the financial a picture of the U.S. and the world and all the debt and the fiat currencies and all of these different things. And it starts to paint a picture that is pretty dire, right? I mean, it's not, at some point, I guess the point here is that there's going to be a reset. Now, is it in the next 5 years? Is it in the next 10 years? Is it in the next 20 years? Well, we have to see how many tools the Fed and the government can pull out of their tool belt to try to keep the patient alive by injecting massive amounts of drugs, aka money, essentially. So again, just things for us to think about, and I want to encourage everyone, I don't trade on this chart that I just showed you. It is more of a somewhat of a longer term, like, okay, how do I protect myself over the next 10, 20 years financially while I still trade the short-term moves and make money? And that's, again, where, something like gold comes into play. Maybe longer term Bitcoin comes into play. Granted, I still think Bitcoin's coming down first, but eventually maybe Bitcoin is in play. All right. So that was just something I wanted to go over here. Let's go back to the charts, guys. I wanted to show you guys a couple other pattern formations today. So what we have is this head and shoulders pattern on Apple. I want to show you an inverse head and shoulders here. This was on Stone Corp. Now, Stone Corp reported earnings yesterday after the bell. And the first thing, and this is actually something Ben pointed out to me, my head trader, and I went into this pattern and he showed it to me and I'm like, man, I should really buy some of this into earnings because the stock has a beautiful inverse head and shoulders, which is bullish, right? So if we put that right here, this is, again, inverse head and shoulders are bullish, head and shoulders are bearish. Well, I ended up not buying any because honestly, I've been burned buying just ahead of earnings many times before. So I said, you know what, I'm not going to take the risk. But take a look at this. You go to this, look at what happens. The stock rips up on earnings. Now, listen, it doesn't always do it, but what we know is patterns tend to give us probability favoring. And that, again, in this case, it did work out. And Stone Corp went up from a close yesterday around 980 to now trading at about 1080 or so, which is just over 10%. So just to show a couple other of these patterns, if we take a look, here's a head and shoulder pattern on the dollar. The dollar head and shoulder, remember, head and shoulders are bearish, inverse head and shoulders are bullish. And if we do our measurement here on this, what do we get? We get a drop from the high of the head down here. And if we look here, what do we know? The target was basically a measured move, and look at where we went to on the US dollar, right? So again, this is, again, a way to do measurements on these type of chart patterns. Another one, and this is one that I actually got a lot of notoriety back in 2021 on, was when I went on David Lynn's show when he was on Kitco, and I talked about the head and shoulders pattern here on Bitcoin. And I said, hey, David, listen, I'm seeing a pattern formation here that Bitcoin, if you do the measurement, is going to go to 30,000. This was the first bull high in 2021. All right, now how did I come to that conclusion? Well, essentially what you do is you take the high of the head, so this is the highest point of the head, here's your shoulder, and you essentially do a measurement from there down to the neckline, okay? And what you do then is you take that distance, right, and getting it as exact as possible here, bear with me as I do that, and you take that distance, and from where it breaks, that gives you your downside target. Lo and behold, when it broke, I said, listen, it's going to go there quickly. And within a week of me saying that, it basically hit 30,000 here, and that was the target. That was the midpoint here, if we remember, in 2021, the midpoint of the bull cycle. And again, these are just, the beauty of this, folks, is that these are patterns that most of us can all spot. And then once you learn that the trigger is when it breaks the neckline and you learn the measurement, again, it doesn't mean the measurement always works out. Sometimes, in fact, price gets back above the neckline and then the pattern fails. But if it doesn't fail, it gives you a basis to say, okay, where can I expect my target to be? In other words, if I'm going to go short Bitcoin or if I'm going to go short Apple in the head and shoulders or the dollar, where can I look to take profits that make sense? Not because, oh, I'm worried about being so much in the money, or, oh, I'm trying to hit a home run, so I want to just let it run, but where on a technical, data-driven basis is the smart place to pull the ripcord and take that money off the table. And that's what we all want, right? I mean, we want something that tells us that's not just our whim and our emotion of where to take our money and run. All right. One other pattern here, folks. Again, this isn't a head and shoulders, but I just want to show you the power again. You guys know I'm a big fan of parallels. Parallels, again, there's something about the charts that create these type of parallels. But look at Progressive here. Progressive making a new all-time high on Monday, but where did it go? Look at the parallel. Low pivot here to the low pivot. You drag it up to these highs, and we literally hit yesterday right there. And look at the reversal candle on Progressive, and then look today. Look, it's dumping out again today. And again, these are just simple patterns that, listen, TradingView gives us, you just go to parallel and you can draw any parallel, right? I mean, obviously you have to figure out what the proper parallel is, but these are not hard tools to make you into, honestly, institutional level investors and traders. And obviously this is stuff I teach in the Winning Trader series. It's stuff that I go over in the game plans and all this other stuff. But again, the point being is that it's here and it's not complex, right? So many people out there are like, oh man, I want to be a great trader, but ultimately, how do I do that when I'm I'm in a point where I'm not institutional level, I don't have knowledge, I don't know calculus or whatever it may be. And ultimately, again, that's all you have to do is just learn simple things. All right. Let's get into current times on Bitcoin here. What we can see again, guys, is this is your trade zone down here. Okay, we bring it down to this area. So this is my zone of support on Bitcoin. Bitcoin is down slightly on check that. It's up a little bit. It was down yesterday. It just continues to chop here. So again, folks, we know our support zone. We know our resistance zone. Sometimes the best thing to do on a chart is just sit back and do nothing. Okay, so again, going back to the chart on Bitcoin here, what we can see is that here's your support zone and here's your resistance zone, and it's just basically equidistant between there. So again, sometimes the best thing to do is sit on your hands and absolutely do nothing on a chart. And in fact, if I looked at 100 charts, there might be one or two that I take action on. Otherwise, I'm just scanning. And again, when you're looking for odds that are 80% or greater, most charts aren't going to fit that as a trade setup to be 80% or greater probability of success. And so, okay, sit on your sidelines, right? All you need, for me, I'm happy with one good trade a week, one good swing trade a week. That's great. That's all I need, and it'll continue to make me money over time. Day trading, one or two good day trades a day. Get the setup, take the money, sit back. While most new traders, and this is something I was like this, right? By the way, I've made every mistake in the book as a new trader, right? When I was in my early trading years, I over traded. I got chopped up on fees. The market swept me back and forth. The algorithms did. I mean, they did it all to me. So I've been through it all. I learned that when I trade less, I make more. Just the simplicity of that. Trade less, make more, because you become more discerning and take the best setups. And really where we all get in trouble, and I still get in trouble to this today, is when I get in a position that's going against me, trying to figure out, okay, where do I cut it? And usually I wait too long and I cut it for a bigger loss than it needed to be. All right, something we all probably have experienced. All right, going quickly here to silver. Silver on the day is slightly lower. Gold, remember, hit that major level. Look at how, again, it is stalling right here. Now, again, if I'm correct, we should see a pullback in gold over the next week or two. How much of a pullback? There'll be support right here around 29.50, secondary support around 28.50, and then really if it gets a big pullback, it would go down to the bottom of the parallel. But this is still an uptrend. This is just a level where historically we've seen a pullback off of that upper range. I did short some GDX yesterday, gold miners. Again, GDX had a monster move up. By the way, you might say, well, you know, I shorted this pretty much at the open. We also did it as a day trade, by the way. But you might say, well, why did I pull the trigger there, right? So, well, simply put, look at the double top going back to 2020. So your August 2020 double top, we just tagged it on yesterday's gap up. To me, that is an extended move into double top. Doesn't mean it's not going to go higher, but is it a good point to start a short position? For me, it is. That's a major double top. Notice I'm not saying, oh, well, I just think gold is going to pull back, or oh, I just think this, or my emotion is this. It's like, no, there's a double top. There's gold is hitting its upward channel. There's multiple factors helping me push that decision, so that I'm making a decision not based off my whims or my emotion, but on actual technical facts, that if I had a board in front of me and I had to justify that trade, I could say it was X, Y, and Z. Boom. There's my thesis. It's based on fact, not on emotion. All right. Oil, let's take a look today. Oil getting a small bounce. Oil was up yesterday and then got a little pullback. There was some talk between Putin and Trump and you know, some lessening on some various things. So again, oil came in yesterday, but it's inching back up. It is starting to form a bear flag. I still think there's a chance it gets up to about $70 a barrel. But again, limited upside, eventual downside. That continues to be my angle. And then natural gas is up today just a little bit as well. But again, this is just hugging this trend line. And what we know is this is generally a bearish pattern. Doesn't mean it can't fail, but right now this pattern, if it continues, eventually should lead, probability-wise, to downside, maybe even as low as like 330, somewhere in this lower vicinity. All right, guys, so again, To summarize, we have lots going on here overall with the Fed decision today, but that could mean that we have some calmer periods here early in the day. That's why I spent a lot of time teaching today. These type of days, we can still put good use to the time here on the game plan to learn about charts, about technique, about discipline, and all of these things, because it's all going towards making us all better traders that can compete and beat the institutions by using logic and data. You guys have a great rest of your day. I'm going to head over to the trading room and start day trading this market. I hope to see you there. You guys have a good one. Take care.